questions will be raised about the Bank of England's decision to raise interest rates earlier this month, as inflation figures for October were lower than expected. Rather than the rise that economists had predicted of 0.1 or 0.2 percentage points, inflation remained at 3.0% in October, according to data released on Tuesday by the Office for National Statistics. While November's vote to raise interest rates was intended to help curb inflation, this decision would not have had an impact on October's data. The flatlining of the Consumer Prices Index, CPI, a measure of how prices for goods and services rise and fall, at 3% suggests that growth in the economy was not forcing prices up as fiercely as the rise in interest rates might have implied. However, Mark Carney, the governor of the Bank of England, will be relieved that, as the 3% figure is within 1 percentage point of the Threadneedle Street's 2% target, he will not have to write a letter to the Chancellor explaining the inflation figures and outlining the remedial action he would need to take. This slower than expected rise in inflation does not mark an end to the cost of living squeeze. Households will still be hit by rising prices, as food inflation continued to climb, hitting 1%, the highest level since September 2014. This was offset by a slight fall in other common household expenses such as fuel. There is a debate between economists as to whether or not this figure of 3% means that inflation has now peaked, or will continue to rise in the next few months. Paul Diggle of Aberdeen Standard Investments believes it could still climb. The impact from last year's currency depreciation, and the latest move upwards in oil prices, still have a few more months to run, he said. Mr. Diggle also noted that this inflation rate was still likely to outstrip weak wage growth and curtail consumer spending, and, as a result, he predicted that the Bank of England will have to hike interest rates at least once more next year. Ruth Gregory of Capital Economics believes that, while the impact of rising oil prices has not yet been felt by UK households, inflation is close to its peak. Ms. Gregory said that producer prices showed that costs pressures has continued to ease, as input price inflation fell back from 8.1% in September, to 4.6% in October, and she therefore predicted a fall, once the inflationary impact of sterling's fall fades in CPI to 2.25% in towards the end of 2018.